Okay, hello everybody. Welcome to Korean Atlanta Mentorship, and we're just going to do another Velocity Banking review here. Did you know from time to time I actually get emails from you, the audience, telling me that I am the very best at explaining velocity banking because I make it so simple. And that's not an accident because actually have a teaching background. And so, one of the things that you kind of have to do when you have a teaching background is you just have to make it really simple and easy to understand, right? And that's what I'm going to do. Just going to do the same thing what I always do for you all the time, making it simple, velocity banking review. And the way that I like to explain it is in a way that you cannot refute what I'm saying. So there are certain things that like I've seen over the years where people present it and the audience kind of like challenges the presenter where it's like, well, why would you use an 8% line of credit to pay a 3% mortgage? That makes no sense, right? And then, the person presenting it is kind of like, not so great at explaining the concept. But the way I would explain it is in a way that you really can't say that it doesn't work, okay? So, the way that I present it is, hey, if you make great income, right, $8,613 and 1 cent, and you have 10 credit cards and an auto loan and a mortgage, and your eyes are filled up to debt, and you on top of that, you have your personal expenses that cost $2,000 a month. Um, and you only have 1 penny left over, do you need to make more money to get out of this hole? That's really the question that I ask, and pretty much every if you ever present it this way, every single person that you know will say yes, right? Because, if I were in this situation, I didn't know velocity banking, and I saw that all I had was, like, 1 penny left over, in my savings because to me, savings and cash flow, were used to be the same thing, right? Because I always thought just from how society brought us up when it comes to banking is that your checking account or your savings account, that number is essentially, your cash flow, right? Think about how people evaluate real estate deals. The average real estate deal that's considered to be good, the cash flow is $200 a month. And what you do is just put the $200 in a savings account in case of emergencies, right? So, what we're going to do is we're going to take the same income and the same expenses because you all said that you need to make more money to get out of this hole and show you um, what we can do so that we can manage the money, manage the cash flow without stress, make it easy. But the most important thing is that we don't save money. Okay. We don't save money and we separate the concept of cash flow from savings. So the difference between here, the average American style of banking, velocity banking, is that how we treat our checking or savings account, right? So here with the average American, the checking account is kind of treated as the final destination, whereas velocity banking, the checking account is essentially the middleman, right? We're not going to save money. So how would this look like in real life? Well, basically money comes in and it just goes right out into something called a line of credit. So what's a line of credit? It's basically a financial tool where you can borrow money, pay it back, and use it over and over again. So this is my $373,500 home equity line of credit. So if you ever go to the bank's website, you just click, hey, I want money from a line of credit, right? Like this one right here. And where does it go? Checking, click transfer funds, bam, it's done, right? So that's essentially how a line of credit works. Borrow as much as you want, put into checking account, or much as you want to limit. And also, credit cards are lines of credit because you can swipe, pay it back, and then use it over and over again. And again, this is just me for an opportunity for me to flex. I have over $739,000 in lines of credit. 739,000. And if you want to know how banks work is that they only lend money to people who don't need it. So because we had, once upon a time we had good income, the reason that we're able to get so much debt is because the bank saw us at a low risk. And what they do or their hope is they want to attract you with um allowing you to borrow money with low payments over time. And then what happens is if you have too many low payments over time, that's going to eat up your cash flow and then it's going to feel like you're drowning. Now, the bank never wants you to completely drown. They just want to get you to the point where it feels like it's going to drown. Because from the bank's perspective, a person who does not pay their bills is way, is like the ultimate deadbeat, right? Like if you're 90 days late on a payment, you're the ultimate deadbeat to a bank, right? The other thing that they don't want is people who pay off their debts too early. So it's kind of like a big balancing act, kind of Goldilocks, right? You don't want people who pay off their debts too early because you can't make interest, but you don't want people who are not going to pay their bills, who are not going to pay their debts, especially if you're 90 days late. Okay. All right. So now let's go ahead and do this. Okay. So, what am I doing? So, what we're going to do is assume we have access to something called a line of credit. And then for this demonstration, we'll assume we have access to $260,000 at 8%. Now, for most purposes, for most intents and purposes, you're not going to be able to get a free and clear line of credit. But if you know how to do the strategy correctly, you probably won't even have to be here, right? So just I'm not going to go into the whole spiel about how banks only lend money to people who need it. Although that is the secret of getting all this credit like I did. 739,000. Okay? So let's go ahead and move some of these debts into the line of credit and we could see how we can increase our cash flow, right? Let's just start off with the credit cards. And how much credit card debt do we have? 5, 8, 15, 27, 30, 7, 10, 35, 12, 15. And I'm going to go ahead and sum it up. And that's $164,000 in credit cards. So let's go ahead and move that here. So what we're going to do is just a simple balance transfer into the line of credit. And guess what happens? Oh my goodness. All these 10 credit cards went to zero. And with the same income, we literally went from 1 penny to $5,1110.84 of cash flow. And then this is the part where if you show other people, they'll just like their mind will kind of freeze. But because they can't challenge you on this, they don't know what to do. In fact, a lot of times this is my personal opinion, if you're way too good, you'll scare off people, right? Because I've literally had people where I showed this to, they don't challenge me. Like I've seen like hecklers challenge other people doing velocity banking presentations. They never challenge me because I presented in a way where you literally told me that you had to make more money to get out of this hole. Well, okay, same money, right? Same money, but somehow we literally turned a penny into $5,000 or a little bit more than $5,000. And then because, a lot of times the audience does want to challenge you and they realize they can't, that's when they run away. All right. So now the final step is you put your entire paycheck into the line, take your expenses out, and then rinse and repeat over and over again. So why do we put the entire paycheck? Well, it does two things. It satisfies the minimum monthly payment. Okay. And also lowers the balance because the balance is based on the average daily balance, right? So we're going to kind of minimize interest by doing that. So I'm going to do this. And then I'm just to do this. Okay. And then so paycheck in. So for example, a lot of times with home equity line of credit, the interest is the minimum that needs to be paid. But if you put your $8,600 here, then the interest will definitely be the payment or the minimum payment will definitely be satisfied because 8,000 is way more than 1,000. And a lot of people fear that they can't do this for some reason, even though it's relatively simple and it's just a big copy and paste job, right? Big copy and paste. So as you can see here, this gets paid off in about 37 months, right? No, see, relatively easy. So 37 months, and I'll show you right here if you don't believe me. 37 months, it gets paid off. Whoop-de-doo. That was easy. And then how much was that? That's 164K. And then I'm going to go ahead and copy and paste this. And then we have two more loans, which is the auto loan, the mortgage. And then this is going to be 37 months. We have a loan calculator to help us figure out what the current balance is. So this is about $8,000. So I'm going to move this $8,000 loan, auto loan, into the line of credit. I'm going to do this right here. And then this is going to be, bam, 8082.30, right? And then we see that it just gets paid off in 1 month. The cool thing is that we've slightly increased our cash flow by $363. So I'm going to put a zero here. And then our cash flow after that is $5,474.68, right? And so at this point, which is 38 months, right? So 38 months. Let's go ahead and highlight that. And that's going to be 184K. Now the next one here, 38 months, right? So now this is zero. We see that the balance is 251,000. So even though this is a 3% mortgage, why do we want to pay it off quickly, right? That's because when you get to the full term, which is 360 months, 30 years, you'll see that you pay 50% interest on a 3% loan, right? So we want to pay it off, but the important thing is we want to pay it off last. Now not going to talk about here about debt payoff order, but it's very important that with the 30-year mortgage, we pay it off last. Now here's the two ways that we can pay off the mortgage. Number one, we dump our entire cash as an extra payment into the mortgage, or we could just use the line of credit. Either way is fine, right? Either way is fine. And sometimes you might want to even use a 30% line of credit to pay it off, for example, like a credit card. And why is that? Is because sometimes in order for us to get more credit, we just got to use the tools that they give us. So, for example, here we have a $17,500 business credit card. This was originally $10,000, but when I kept swiping it because I was setting up an Airbnb, magically they changed it to $17,500, and we could do that with paying off our mortgage. So even with the 30% credit card, this will work. So, for example, and we do something called chunking, which is just moving a piece of the loan to the line of credit. And so if we chunk $9,000 into that line of credit, you see that even at 30%, in 3.5 years, this you only pay 18 grand interest. And then if we use an 8% line of credit, only 14 grand. So it makes like a 4 grand difference. But here's the thing, you could probably make that up if you have like a cash rewards card while you're doing all this. So it's probably going to be a wash, but at the same time, I think it's really cool to be using a 30% line of credit to still pay it off, because if you make $10,000 swipes, man, the credit card company is going to expand your credit in no time. Okay. So that's one of the ways that we can do it, right? Line of credit, or just pay directly into cash. But let me just kind of go here and we'll see that right here. We paid it on 3.4 years. So what we do is this is zero. This is gonna be 38 divided by 12 plus 3.4, and that's 6.57 years. And we are debt free. Okay, debt free. And yeah, so you ever watch those velocity banking videos where it's like pay off your mortgage in 7 to 10 years? No. We pay it off in 4. Okay, we pay off all our debts under 7, but we can pay it off in 4. Okay. All right. Well, that's it for today, folks. We're at the 12-minute mark. See how fast that was? So I did it relatively fast just today. And yeah, well, I don't have anything else to say. So this is Korean Atlanta Mentorship. Let me know if you think of what I said is true, that I explain it super simply, right? Okay. All right. Have a great day, and I'll see you on the next video.